While the mainstream gaze is fixed on red candles and retail volatility, a complete engine swap of the global financial system is being finalized, not in the public markets, but within the secured halls of Davos 2026. We are no longer in a standard trading cycle. We are entering the phase of institutional foreclosure. This isn't just about assets becoming more expensive. It's about the window of accessibility for the average person slamming shut. When the world's leading asset managers speak about regaining trust and a post-Bretton Woods architecture, they aren't speculating about the future. They are announcing that the system is already live. And once the switch is fully flipped, there is no turning back. Before we go under the surface, a necessary note of order. This briefing is built on institutional data flow analysis and structural modeling. However, I am not a financial advisor, and this is not financial advice. In the world of sovereign debt and trillion-dollar shifts, the risk is as real as the opportunity. In this briefing, we examine why the sea of red in today's market is actually a smokescreen for the largest institutional accumulation in history, and how protocol value is being converted into sovereign liquidity. We must look beyond the immediate noise of the market charts. What we are witnessing in this opening month of 2026 is not a typical market correction, but a systemic migration. The global financial order established in 1944, the Bretton Woods system, was built on a singular foundation: trust in a centralized reserve. But as the latest briefings confirm, that foundation has reached its structural limit. The leaders of the world's largest asset management firms are now openly admitting what was once whispered in private. Institutional mistrust has become a systemic risk. When the architecture of trust fails, the global economy requires a new engine. Not just a faster one, but one that operates on neutrality. We are moving from an era of debt-based trust to an era of protocol-based truth. Think about the scale. We are looking at a $10 trillion to $150 trillion market transition. This isn't like the early days of e-commerce. This is the digitization of the entire global value stack in the corridors of power. This week, the conversation has shifted from if this will happen to how fast the pipes can be laid. The New World Order in finance isn't a political conspiracy. It's a technological inevitability. Governments and central banks have realized that to survive the age of populism, they must adopt a ledger that no single nation can weaponize. This is where the concept of the neutral bridge asset becomes the most important mathematical factor of our decade. For a sovereign entity, using a digital asset isn't a bet. It's a risk mitigation strategy. It is the only way to move value across borders in 3 seconds without relying on a legacy system that is buckling under its own weight. But here's the detail most people miss. Liquidity is the ultimate barrier to entry. To run a global engine that handles trillions of dollars, you cannot have a cheap bridge asset. If the bridge is too narrow, the value gets stuck in the pipe. This is why the institutional accumulation we are seeing right now is so aggressive. While the masses are focused on the price of the asset, the architects of the new system are focused on the math of possession. There is a term being used in high-level institutional circles this year: the great priced out. It is the moment when an asset transitions from a speculative instrument for the public to an operational utility for the elite. Let's dismantle the illusion of cheap versus expensive. In the retail mind, an asset at $1.90 is cheap because it was once higher. But in the institutional mind, price is secondary to scarcity and volume. As we move further into 2026, we are witnessing a violent repricing, not because of hype, but because of mass accumulation. Consider the current state of the rich list. Data from global ledgers shows that fewer than 500,000 accounts worldwide hold more than 10,000 units. And that number is shrinking because institutional dark pools are absorbing the float. This is the liquidity trap. Imagine an individual trying to build a position of 10,000 units. As the price discovery phase accelerates, moving from $2 to $7, then towards $17 and beyond, The purchasing power of your monthly surplus collapses. Your cash flow does not scale with the protocol's value. Ownership of 10,000 units, which once felt attainable, will soon be viewed as a sovereign-level stake. We are watching a sea of red in the markets today. But look at the exchange reserves. They are at 8-year lows. The tokens are not being sold into the market. They are being captured and locked. Once these sovereign bridges are fully integrated, the velocity of money will be so high that the price must adjust to handle the load. There is a final critical layer to this transition. It is the psychological barrier between those who watch the system and those who build it. We are told by the pioneers of this technology that the greatest challenge in innovation isn't the technology itself. It is the ability to drown out reality suspension. In these early weeks of 2026, the noise has reached a fever pitch. The haters serve a specific function in the institutional cycle. They provide the sentiment cover necessary for large-scale accumulation. While loud voices argue about details, the silent actors are integrating the operational bottom. Understand this. Once you turn these systems on, there is no going back. We are not entering a new phase of the old world. We are entering a new financial dimension. When a sovereign nation flicks the switch to an on-demand liquidity model, the friction of the past evaporates instantly. The founders of this movement have always maintained a singular thesis. If there is real utility, and if that utility solves a real-world problem for a real customer, the value will follow. In 2026, the real customer is no longer the retail speculator. The real customer is the central bank. It is the global custodian. They are not looking for a quick trade. They are looking for systemic stability. The mathematical floor of 8, the institutional targets of 17, the long-term vision of a triple-digit bridge. These are the logical consequences of a world that has decided to move 150 trillion onto a ledger with a fixed supply. If you have stayed on this journey, if you have focused on the pipes rather than the price, you are on the right side of history. Remember, health is wealth. Keep your mind clear, your body disciplined, and your conviction anchored in data. The world is about to witness the birth of the Internet of Value, and the door is closing fast. I am the calm analyst. Knowledge is the only hedge. Stay sharp.